gentlemen, today's topic is about double entry system, and I'm looking at accurate and balanced bookkeeping in the organization. Our introduction of the topic will be double entry system. What do you understand by double entry system? It is a fundamental method of bookkeeping. We all know way back in the 90s, in the 21st century, in the 20th and 19th century, people used to keep, for example, in accounting currently, even in a ministry, the government ministries in Uganda, you find that they have a lot of paperwork. They write here, there. So at the end of the day, you find that you have to have proper records. So that is literally what we call bookkeeping, where you're writing receipts, payment vouchers, you're writing maybe the pay slips, those things. So double entry system is a fundamental method of bookkeeping. It ensures accurate recording of financial transactions. Financial transactions are those transactions that involve money, like you have to do something. Exchange is in monetary terms. This presentation will also provide an overview of the double entry system and its components. Some of the components in the double entry systems are the accounts. Accounts represent specific financial elements. For example, assets. In a company like where you are, whoever is working, we know that we have assets. Assets are those long-term items that a company uses and reuses over and over to make money. For example, printers, furniture and fittings, computers, etc., photocopiers. Those are assets. They are tangible. But we also know that we have intangible assets like goodwill, because your business, after opening up a business, you register it, for example, in 1990, and currently it is 2023. It has gained what we call goodwill, the value your business worth. So those are assets. And we have liabilities. Liabilities are these things that the company has to pay. For example, you have trade payables, you have loans to pay, salary, expenses, the administrative expenses that are not paid in their actual time but are paid later after a supplier has invoiced you. Those become liabilities to the company. We have equity. When you're opening up a company, you will have share capital. Your share capital can be like, for example, on a face value of 50 times 100 shares to get the total face value of your share capital, the money that the directors put in the business to start it. We also have revenue. If you're in a selling business, for example, the product businesses, they sell items. However, we also have the service-related businesses which sell services. Like, for example, in the accounting profession, we sell professional services like accounting, bookkeeping, taxation, tax consultation, auditing services, etc. So each account is assigned a unique number. What do we mean? When you're opening up your, for example, in a company like Science Logistics where I'm working, we have an accounting system. So when you're opening up your chart of accounts, you have to assign identifiers. Even in the books that we write, we have payment vouchers, but you attach a serial number to be able to identify on which payment voucher number did I spend on which date. So you uniquely identify a given document with its serial number. So in accounting, as we know that auditors come to revise the information that accountants have given. So the only way for us to identify the chronological flow of transactions is by putting identifiers. Then also transactions are recorded in their respective accounts. As we have said, that these accounts can be asset accounts, liability accounts, revenue accounts, expenses. We know that expenses in the company, for example, rent, water, those utilities, salaries, wages, all those are recorded in the expense accounts. We shall also look at another major component, which is the debits and credits. Debits and credits are entries made in the accounts. Those accounts that we have just talked about, the assets, liabilities, equity, expenses, etc. So we know that debits increase our assets and expenses. However, we also know that the debits will also reduce our liabilities, and equity also revenue. So the accounts that are affected by the debits in a positive movement, we know them now. We also know that credits are increased by the liabilities, equity, and revenue, but decrease assets and expenses. Another component, we can look at the dual effect. You know, when you're debiting in the system, you have to debit two accounts. One is a debit, the other is a credit. So every transaction affects at least two accounts. One is a debit and the other account is a credit account. Total debits and total credits for each transactions must balance. For example, if I'm buying books for maybe books of original entry in the company, I'll debit my expense, because we said expenses are increasing, by debiting, and then I'll credit where the money is coming from. Is it coming from the bank? Is it coming from cash at hand? So by so doing, we know that we are now balancing our account. Yeah. So we shall look at ledgers. It is another component that is very important for in a double entry system. The ledger is a collection of all the accounts used in the business. It contains transactional details, that is to say, the dates, descriptions, amounts. And also we shall look at a ledger also having transactions recorded chronologically in the ledger. That means you're recording transactions as when they occur. For example, you bought water on the 15th, record it. You bought water on the 13th, record it. So like that. So you put your description, a narrative that everyone can be able to understand. We have another component called the trial balance. A trial balance lists all accounts and their balances, and you know that we have looked at those accounts up there. Accounts can be in form of the expenses, liabilities, equity, or revenue, etc. And we also look at the trial balance as one that ensures debits and credits are in balance. So you cannot say that it is a trial balance if it is not balancing. It has to balance. If debits equal to credits, the trial balance is then said to be balancing. Then what are the benefits of having double entry system? One of the benefits that I'm looking at are maintaining integrity of the financial records. Like if you have proper records and you have documentary evidence, it is very easy for someone to say that, yeah, the financial statement depicts a true and fair view of the affairs of this organization. It also ensures accuracy of financial statements. We know that we have 5 accounting statements, and that is the income statement, the balance sheet, the cash flow statement, statement of changes in equity, and cash flow statement. So if you're putting in correct information, you can always trace this information from your source document. And lastly, it enables better financial analysis and decision making, because if you're making decisions, you have to look at the evidence that the accountant has in their files. And in conclusion, I will say that double entry system is a vital tool in bookkeeping. It helps in balancing records of financial transactions, and it provides a solid foundation for financial management and analysis. Thank you so much for listening to me. If you have any questions, you can put it in the chat room. I will be able to answer you. Thank you so much for listening to me. I remain as Ruth Mirembe, and I'm very happy to have presented to you a topic about double entry system. Thank you so much. Thanks,